Hello, my name is Tom Clendon and I help students pass the ACCA SBR exams by talking and creating content around accounting standards. And on my LinkedIn page, I recently invited comments as to what I could be podcasting about next. And it was suggested to me that I should talk about the accounting for financial guarantees. And that's exactly what I'm doing here now. And the subject intrigued me because when I thought about it, I realized there were 5 different accounting standards that I'm going to be name checking during the course of discussing about accounting for financial guarantees. Now, I want to look at this topic from the perspective of the guarantor, somebody who gives the guarantee. So someone else is borrowing the money. I'm entity A. I'm giving the guarantee. I'm the guarantor. And there will be an entity B who's borrowing money from a bank or borrowing money from somewhere else. And to give the lender to B that comfort, they get a guarantee from me, A. I am the guarantor. So let's imagine it's $100 million over a 5-year period. As the guarantor, I don't get any of that money. And let's just imagine that $100 million over 5 years, we assess the risk perhaps that the person who borrowed the money, entity B, might default on that. Let's say the risk of that is, say, 10%. So let's put that in a box because I want to use and come back to that because I can teach you how to account for financial guarantees by referring back to that example. So as the guarantor, when I give the guarantee, no money changes hands. It's not a cash transaction. But if the borrower is my subsidiary, if I've given the guarantee on behalf of my sub, on behalf of my associate, on behalf of my joint venture, on behalf of my key management, on behalf of a major shareholder of the company, it will of course be a related party transaction. So ISA 24 is potentially, in play. That's my first accounting standard that I'm mentioning. You would disclose. Who else might you provide a guarantee for? Because it's logical to provide a guarantee for your sub. You might guarantee a charity. If you were benevolent, if you had good corporate social responsibilities, one of the things that a large, powerful, financially stable organization might do is to provide some form of assistance in the form of giving those guarantees. So the charity borrows the money and we stand behind the charity in the event of default. So it's not a cash transaction, but we now have a liability of uncertain timing or amount because we may be called upon at any time to pay back the loan if the original borrower defaults. And of course, having a liability of uncertain timing or amount is the definition of a provision under ISA 37, the second accounting standard I'm mentioning. Now, we recognize a provision when all 3 conditions are met. First of all, there has to be a present obligation, which is legal or constructive. So clearly, giving a guarantee creates that legal obligation. It's written down, it's enforceable. But to recognize a provision, there also has to be a probable outflow of economic benefit, which is capable of reliable measure. That probability is a threshold that has to be met before we recognize. Now, the guarantee we've given, we've assessed that there is a 10% chance of default. And therefore, because there's only a 10% chance of default, there's no way, Jose, there's no way we are going to recognize a liability. So what we've got is a contingency. What we've got is a disclosure in the notes, because under ISA 37, It operates an all or nothing approach. Probability is a criteria for recognition, not a measurement issue. Now, the next accounting standard I'm going to mention is financial instruments, IFRS 9. Because actually giving that guarantee creates a financial instrument. Giving that guarantee is a contract that creates a financial asset in one entity and a financial liability or equity instrument in another. We as the guarantor have created a financial liability because we've given the guarantee. Now, under IFRS 9 financial instruments, when you're dealing with financial instruments, the initial recognition is at fair value. You don't have a probability threshold to overcome. And therefore, because it's a different approach, we initially recognize at fair value, we're going to have a different solution or a different accounting for this guarantee. Now, I've mentioned fair value. That's my fourth accounting standard, because IFRS 13 tells us how we measure fair value. Now, we normally think of fair value as assets. We normally think of fair value as market value. But strictly speaking, fair value is the amount you would expect to receive if you're going to sell an asset, or the amount you would have to pay to get rid of a liability between informed parties, between market participants, in other words, strangers. So we can arrive at a fair value of our guarantee in these circumstances, because there's a 10% chance that we're going to have to pay out 100 million. And you can insure yourself against that. You can think of the fair value there, not at level 1, not at level 2. There's no market to observe, but you can arrive at an expected value of 10 million. So we can measure under IFRS 9 the initial recognition of the guarantee having a fair value of 10 million. So we've got this conflict between ISA 37 saying provision 0, but under IFRS 9, the initial recognition of the liability is 10. We take the higher figure. We take the higher figure in these circumstances, and the higher figure is 10. So when we give the guarantee, we recognize a liability of 10, credit liability 10, debit P&L expense 10. So you're charging profit with 10, profits go down. Now, my fifth accounting standard that I want to mention is cash flow. ISA 7, operating, investing, financing. And normally we do the indirect method for operating activities. And we've got here an expense that we've charged against profit of 10 that we haven't paid for. There's no cash outflow. So just like depreciation, just like impairment losses, this 10 has been charged and has reduced profit, but hasn't resulted in an outflow of cash. Therefore, we add it back in that reconciliation. So my fifth accounting standard there is cash flow, if I'm talking about the topic in the round. But I wonder what happens next, because all we've talked about is the giving of the guarantee and the initial recognition. Now, if we think of that liability as being 100 million, the original loan to entity B was 100 million. We've guaranteed that, and we recognize a liability of 10. If we think of that loan as a 5-year loan, and our subsidiary and our charity over the next 5 years systematically pays off that loan, so that loan goes from 100 to 80 to 60 to 40 to 20 to be extinguished in 5 years, then our exposure to the guarantee will also come down. Because if we initially recognize our guarantee as a liability of 10, as the loan is being repaid each year, so the amount of our guarantee should also correspondingly come down. That seems logical to me. So every year there's an annual write back. So every year, because it's a 5-year loan being repaid over 5 years, every year 1/5 of the 10 would be reducing the liability. So the liability would go 10 to 8, 8 to 6. And each year there would be a credit back to the profit and loss account. So that's what would happen next if the loan was systematically repaid, systematically extinguished. Our initial recognition of our liability would also then come down. But intriguingly, of course, there is the possibility that the charity or our subsidiary defaults on the loan. And let's think about what happens then. So let's imagine this happens after a couple of years. This happens in, say, year 3. And we've already made 2 years of accounting. So the entity has already paid back the first 20 million and the second 20 million. So after a couple of years, the loan is only outstanding at 60. And our guarantee, our liability in our books, which was 10, we've knocking that down. That is now 6. And now the charity goes bust. Now the subsidiary goes bust. Now the lender calls upon us to honor the guarantee. And the guarantee is to pay off that loan. And that loan is now 60 million. In our books, however, we've only got the guarantee at 6. So we've got to suddenly jump up from 6 to 60. We've got to remeasure that liability by 54. That's an extra expense of 54. Instead of it being sort of a current, non-current situation, it's presumably all going to be a current liability. So we've got an extra expense of 54, debit the P&L 54, charge the expense of 54, and credit the liability by 54 to become 60. And then obviously when we actually honor the guarantee and find the money, then we extinguish that liability through a payment. So what a great question. And I'm so glad that that person made that contribution to my LinkedIn account and asked me to discuss financial accounting, the accounting of financial guarantees, because it made me talk about a number of different accounting standards, potentially related parties, provisions certainly, financial instruments, why not fair value, and also I brought in cash flow. And actually in the exam, problems are not always going to be solved in silos. You are going to have to potentially discuss things in the round. And in doing so, you don't need to regurgitate the particular number of the accounting standard. Now, I happen to know, because I'm a tutor, that related party is ISA 24, that fair value is IFRS 13, but there are no marks available for quoting the numbers of those accounting standards. So thank you for listening. Please subscribe to this podcast. And if you do want to pass SBR, if you do want further support from me, reach out. You can contact me through LinkedIn. You can contact me through my website, www.tomclendon.co.uk, or you can just WhatsApp me. My WhatsApp number is 07725 350 793. I'm here as an online tutor to help students pass their SBR exam. So thank you very much for listening.